Welcome to the Value Investor TV podcast. This is the podcast to help you grow your wealth and become financially independent. My name is Becco, and instead of my partner, Hari, I have here a very special guest, Kevin Carter. So a quick introduction. Kevin is the founder of EMQQ Emerging Markets Internet and E-commerce ETF, the ticker symbol EMQQ. He's also the chairman of the EMQQ Index Committee. Prior to that, he was the founder and CEO of Alpha Shares, an investment firm offering 5 emerging markets ETF in partnership with Guggenheim Investments. So it's truly an honor to be hosting you, Kevin, and welcome to the podcast.
Thank you. Glad to be here.
All right, awesome. So this is going to be a bit different podcast than previously. We have this a special guest, and Kevin, you've been in the industry for a long time, and so we'll talk about various topics such as fundamental value investing in emerging markets. Obviously, you have a lot of experience in investing in emerging markets, and then also talk about the election that just happened and some of the hot names that are in the index that you have particular interest in, such as Alibaba,
Sure.
Tencent, Paytm, etc. So let's start off with your background. So Kevin, tell us a little bit about who you are and your sort of focus in terms of investment.
Sure. Well, I'm an investor, and I worked in the investment business here in the Bay Area for 28 years. And for the last 15 years, I've been focused exclusively on emerging markets. And as you said, I'm the founder of an emerging markets internet ETF that invests in Alibaba and all of the other publicly traded internet companies around the world.
Yeah. So what got you interested in emerging markets to begin with?
Well, I think I was always sort of interested in emerging markets, and I did my first real extensive travel in emerging markets 23 years ago after I got married. My wife and I traveled through South America and Africa, and that really piqued my interest. And when I got back from that trip, I definitely dug in and found whatever I could read to learn about emerging markets investing. But I didn't really get involved as a professional endeavor until 15 years ago, when my business partner Bert Malkiel had been asked to give a talk at Google when Google went public, and I wasn't involved with that, but he gave a general talk about investing, and soon after that, some of the Google people called me and said, "Hey, we heard about this active indexing strategy you do. Can we invest with you?" And I said, "Well, maybe. Let's meet." And I ended up becoming the investment advisor to about a dozen of the earliest Google people. And right about the same time, that's 2005, Burton had been going back and forth to China, and ended up writing a research paper about investing in China. I wasn't involved with it, and I had never been to China, but the guys at Google found out about it and called me and said, "Hey, can Burton give a talk about investing in China?" And so 15 years ago, we drove down from San Francisco to Mountain View one day, and Burton gave his talk about investing in China, and all these Google guys looked at me and said, "We want to invest in China." And that literally, from the moment that talk ended until today, my entire professional life has revolved around figuring out what does that mean to invest in China, and how would you possibly do that? And China is, of course, the largest emerging market, not the only one, but it's the one that counts the most by a stretch. So that's how I quite randomly got involved with emerging markets.
Yeah, that makes a lot of sense. You started talking about like how you were interested in South America, and then sort of moving on to China. You still obviously have a lot of interest in emerging markets as a whole, but you're really focusing on China at this point. Did I understand that correctly?
No, I'm focused on all of them, but China is so much bigger than the rest of them combined, from a GDP basis, from a consumption basis, and from a population basis. So China remains the majority of what I do. It's about 2/3 of our fund, and it's what people are. Nobody calls me and asks me about what about the problems in Turkey or the trade war with Poland. So it's a China-centric world, and in particular in emerging markets in the internet space.
Yeah, that makes a lot of sense. And this is really interesting that, you are really focusing on emerging markets, but then you're also digging even further, going into internet and e-commerce. So internet and e-commerce in the emerging market is kind of your niche area.
That's my area, and it's a big area. I mean, it's the market cap of the companies that we hold is over $1.5 trillion. So it is a niche, but it's a big and important niche, and I think the fastest growing part of emerging markets for sure.
So let's talk about kind of the last bit there, the fastest growing parts of emerging markets and emerging market as a whole. Why do you think it's so special? What is so special about emerging markets? Why should people look into emerging markets as an opportunity to as an investment opportunity?
Sure. Well, emerging markets are the world. I mean, in terms of the world's population, it's 85% emerging and frontier markets, and it's even more of the future if you count people under the age of 30, where they're about 90% of the world. So this is where the people are. Their economies have been growing twice as fast as the developed markets. And the emerging markets are now bigger than developed markets on a GDP basis. And so that's why investors should be interested in investing in emerging markets. And it's only going to get bigger. I mean, they're going to dwarf the developed markets in 20 years in terms of GDP and consumption. Mm-hmm. And really, it's the consumption story that everybody should be focused on in emerging markets.
Mm-hmm. One of the things I heard a long time ago was that the surest way of growth is population growth, and population growth that goes into middle, the middle income bracket growth. And to your point about consumption, I totally understand that. And so I want to kind of pivot a little bit and talk about, since we are the Value Investor TV podcast, you should talk about how you approach investing from your orientation standpoint. So I know you always say you pray towards Omaha. So maybe you could talk about your kind of philosophy behind investing and sort of your value orientation.
Sure. So I think, sort of a unique person in the investment world in that I am a value investor, and as you said, I pray towards Omaha, and I try to think about every business and investment decision through my interpretation of a Charlie Munger and Warren Buffett lens. But for the last 20 years, I've had one foot in the world of indexing in partnership with Bert Malkiel, who I mentioned earlier, the author of A Random Walk Down Wall Street, and one of the sort of founding fathers of indexing and a longtime Vanguard board member. So I understand the case for investing on an index basis, and the fact of the matter is that mathematically it's really indisputable that if you're going to buy a mutual fund, an active fund that charges you 1% is going to almost certainly over the long haul underperform the index fund that's essentially free. So I understand the indexing world, and it's hard to dispute it. And even Warren Buffett believes in indexing and is pledged to have all of his wealth invested in a Vanguard index fund. And in fact, it was Warren Buffett in the 1996 Berkshire Hathaway annual report that sort of opened my eyes to the mathematical truth of why as he said, most investors, both institutional and individual, should index. So, but in terms of my philosophy and my sort of interpretation of value investing, it evolved. I know that, when I first started in the workforce and tried to read everything, you read Graham and Dodd and you read Security Analysis, and that was really about trying to buy dollars for 50 cents, right? I want to find undervalued assets. The market cap's 50 million, but the factory's worth 100 million, and so that was your margin of safety. And I think that kind of, quote unquote, value investing is kind of dead. And I certainly don't think Warren Buffett and Charlie Munger think about value investing that way. But I do certainly have a value orientation. And I think that the thing that really opened my eyes to to better think about value investing was the writings of Peter Lynch, and who was the star Fidelity manager, and he talked about the PEG ratio and explained why you're buying the future, so you can justify paying a higher PE if you've got high G as measured by growth. And so the PEG ratio to me is really the only valuation metric that matters. If you tell me the PE of something without telling me what the growth rate looks like, I have no opinion. And so I'm a value investor, but I think every investor should be looking for growth. And so what I'm really looking for is GARP, growth at a reasonable price, or low PEG ratios. And then the other things I would say in terms of my philosophy, I think that what you really want to buy are great businesses at good prices, right? And that's certainly something that Charlie and Warren Buffett talk about a lot. And so I look for recurring revenue, right? So I want, as Warren Buffett says, it's easy to go to bed at night knowing there's a billion or billions of men are growing beards, and it makes him comfortable owning Gillette because they're going to have to shave him the next day. And so there's all different ways to think about recurring revenue. It might be coffee, right? A lot of people in the world can't start their day without a coffee. So having something that people want again is great. Having something that people need on a regular basis is even better. That whether that's cable TV, subscription type businesses, but I think that's the first thing I look for. And then I look for a moat. And where I look for moats is on the income statement. And that's a Charlie Munger and Warren Buffett term. But basically, it's what protects your profitability so that you can make an outsized return on your product versus somebody else's. And in the case of Nike, that moat is produced by the swoosh. There's different types of moats, but I think where the moat shows up on an income statement is at the gross profit line. If you can have a high sustained gross margin, the odds are you have a moat because the world's competitive. And if I make a table and I make it for 10 and I sell it for $100, then you're going to start making tables too and making them for 10 and selling it for 90, and then eventually they'll sell for $10.50. So I look for moats, and high returns on equity and assets will almost always follow that moat. And then I look for growth, and then what I care about is that's the what you want to buy, right? Great businesses, and there's not that many great businesses in the world, right? I mean, the world's a competitive place, and if you can find a position for yourself where nobody else can make what you make, and you can charge a premium for it, there's not many businesses that have that, a durable moat. And then you want growth, and you want to pay the right price tag for it and hold it.
Yeah.
The miracle of compounding is I always knew it was important, but I slowly began to appreciate it more and more. But my biggest investment mistakes were selling things too early and not letting them just go and go.
Yeah, that seems to be the common kind of a thread that I hear when I talk to investors is that, oh man, I sold too early. It seems to be like the common, and then also a error of omission. Oh, I missed it. I knew this was a good investment. I missed it. Mm-hmm. Those are two things that I hear all the time.
Well, I'm getting in a bad. I'm getting in a bad mood because I'm thinking about the different things that I missed. You know what, right? Or that I sold too early.
Yeah, exactly. You touched on. Let me just quickly recap on some of the things we talked about here. I think really lots of good stuff here. So we talked about indexing versus picking stocks on your own. You also talked about value investing, sort of new age value investing versus old age of value investing, buying a dollar for 50 cents versus kind of a new age of, even though you might be paying a little bit more than you want, you're actually buying really good businesses and thinking about investing from that standpoint. You also talked about a few things that you look for, kind of a checklist, if you will, right? Recurring revenue. You talk about moat that you find you try to parse out in the income statement. And And then you talked about return on capital, and then the growth story, and then just having the patience to hold on to it. What I noticed, something that you didn't mention, is management. And so where does kind of management play into your checklist?
I've never put a high value on that. Obviously, well, let me use a Buffett term, or a Buffett expression. You, let me think if I can remember it exactly. One of the reasons you want great businesses is because, as he says, they're so good that even an idiot can run it, because eventually one will.
Yeah.
And then the other quote is, if you take a great manager and combine him with a bad business, it's the business that keeps its reputation. So that's part of the reason I think about that. But also, when I was a younger investor and an analyst, and you go and meet with an executive in a hotel room, conference suite, or what have you, and they're going to tell you what they want you to hear, right? I always used to joke. I said, what I really want is like a hidden camera in his house on Friday night and Saturday to see what he's really got going on. But so I don't put a lot of importance in that, and I've ended up talking to management teams at certain points, but it's not a priority for me in making an investment decision.
I see.
Yeah, I mean, it assumes that you're not just a good judge of businesses, but you're a good judge of people, and I'm not that. Mm-hmm. I don't think, and so that's maybe another reason that I don't put that much faith in that.
I see. Yeah, the part about Warren Buffett talking about, because one day an idiot will run it. I certainly I think there's a lot of wisdom in that. What do you think about some of the businesses that I personally own, and some of the businesses that our listeners own? And we talk about this all the time in the podcast, is look for businesses that have high percentage of insider ownership. How much of that goes into your investment process?
Well, that's obviously very important, and you want the management team to be incentivized. So yes, if the people running the company have their own wealth on the line, then that you're going to get their best effort. So I do put value in that. On a related note, though, I don't put a lot of value in like insider selling, for example. But I do put a lot of value on insider buying, because as one of my mentors used to say, people sell stock for a lot of reasons, but they only buy it for one. Mm-hmm. And so if people that say, oh, the insiders are selling, maybe the guy's got a kid to put into college, or a donation to a charity, or a yacht he wants, or what have you. But so you don't know why he's selling, but you know why he's buying.
Mm-hmm. That's a nugget of gold right there. Thanks for sharing that. I'd like to kind of pivot and kind of talk about the topic that we discussed earlier in the podcast, which is your focus on emerging markets. Obviously, it's a very attractive space for lots of people, including your ETF and people who invest in your ETF. But for those who are thinking about going into emerging markets, trying to diversify, or really want to get into emerging markets, as someone who's been in the business for a long time, as a veteran of the investing community, what are some risks that people have to think about when they are thinking about emerging markets? Is there anything in particular that is particular to emerging markets?
Well, yes, all investing is risky, and emerging markets investing is even riskier, as measured by volatility, and also I think by sort of real risks. And those things include government problems that are, significantly bigger risks in emerging markets. I mean, you've got nationalization of businesses, which has happened in Argentina and other places. So I think it's just a riskier part of the world. But the biggest problem, the biggest risk is investing in emerging markets is is that you just go buy the index fund, because that's not the right way to do it. And uh, the problem is that the traditional indexes are full of something that we don't really have here in the developed world, and that's state-owned enterprises. You've got government-owned banks and oil companies, and so as I always tell people, like, imagine the Department of Motor Vehicles crossed with your bank, or the Department of Motor Vehicles crossed with your gas station. And these are not efficient businesses. They are conflicted. They do things for reasons other than to grow, shareholder value. And these companies are about a third of the broad indexes. And if you counted, there's two other groups of companies in emerging markets that have a lot of the same problems. And those are the former Soviet state-owned enterprises, which are now controlled by the so-called oligarchs, and the Korean chaebol, the Korean sort of almost mafia conglomerates that have a lot of the same problems, including people stealing your money and going to jail for it. In the case of both Brazil and Korea, you've got executives and presidents of the countries going to jail for essentially stealing your money if you're using a traditional index fund. So corporate governance is probably the biggest problem in emerging markets. And so I think for that reason, you shouldn't use a diversified index-based approach, and should get a little bit more precise in how you target where the real growth is, which is in the consumer.
Interesting. So just to recap what you said there, you said a third of the company in the index, emerging market index, is somehow involved with the government, and that leads to is that
controlled by the government?
Controlled by the government, controlled and owned by the government, partially or fully.
Partially owned, fully controlled.
Partially owned, fully controlled by the government, and that leads to conflicting interest, as well as just being inefficient in terms of just corporate governance and being able to be capitally efficient.
Yes.
And therefore, you're looking into consumer space, you were saying.
Yeah, so that, I concluded about 8 years ago, that even earlier, that you really, if you looked at the index for China in particular, where I got started, and the first day we got back from Google, and I say, well, all right, give me a list of all the companies in the China ETF, because I assumed that, for these Google guys, we would just buy that. And I got and I like to look at all the companies to see what I'm actually owning, and so I asked for the list, and before they gave me the list, Burton pulled me aside. He goes, look, when you look at the list, you're going to see that almost all of it's Chinese government-owned banks and oil companies. And he gave me an example of a Chinese state-owned bank, and there's a manufacturing plant in town that's got 15,000 employees, and it's been losing money, and it's about to go bankrupt. It goes to the state-owned bank and says, hey, we need more money. Now, a normal banker would say, no, you can't have any more money because you didn't pay us back the last money. But the state-owned bank is conflicted, and the state-owned banker says, well, if you run out of money, all these people will be out in the streets protesting. We can't have 15,000 people out in the streets rioting about losing their jobs. So here's another loan. And that made me nauseous inside, because, with my simple Omaha brain, earnings equals value, and the growth of earnings equals the growth of value. And so the people that run the companies don't care about that. Why would I invest in them at all? And then the consumer part of the China ETF was only like 8%. So you realize pretty quickly that you got to get more precise if you're going to make any money. And that's what people look at the returns of emerging markets, and they haven't made any money in 10 years. And I think that when investors look at emerging markets and they see, look at the PE in emerging markets is 11 or 10 or 12. It's half the PE of the S&P 500. And then they look at the GDP growth. They say, it's growing twice as much as the developed world. So I'm getting twice the growth of the economy and half the PE multiple. That is the biggest value trap in the world. And time again, I see some chief investment officer from some wirehouse, and he's very bullish on emerging markets because of, the currencies or the whatever. And then they say, yeah, go buy the emerging markets ETF, the MSCI. And I think that will not result in a good outcome, because it might look cheap on paper, but if you really knew what the agricultural bank of China was, you probably wouldn't want to own it at 3 times earnings because it's not there to serve you as an investor. It's got all sorts of other issues. And so I concluded that what you really ought to do is just tap into the consumer story, and you should leave out the legacy economy, leave out all this junk that fills up the index, and just buy the consumer sector. And because that's where the growth is. In fact, it's such a big growth story that McKinsey calls the growth of the consumer the biggest growth story in the history of capitalism, right? And that's a big and respected firm, and that's a hyperbolic statement. But even if they're wrong and it's the second or third biggest opportunity, it's still a big deal. And if you're investing in emerging markets, that's what you want to invest in, because the thing that is emerging are the people. There are billions of people, and they're moving on up. And as they move up, they want stuff. They want more and better food, more and better clothing, appliances, vacations, cars, and they want their kids to go to Harvard. And that's the story, and it's well documented, and that's really all that any investor in emerging markets should be looking for.
Yeah, it makes sense. Makes sense that you sort of narrowed in and focusing on the internet and the e-commerce space as a reflection of this belief that you have about really going consumer and leaving behind the legacy. So awesome. Well, this is probably a good point to stop this first part of the episode. So before we do that, any sort of words about how people can contact you if they want to, reach out to you, learn more about you? What are some social media? If there's anything that you keep up with, you want to talk about them really quick?
Sure. Well, you can find us at EMQQindex.com. That's our website. And you can also find me at bigtreecapital.com. That's the name of my sort of company I operate out of, but EMQQ Index or Big Tree Capital. You'll find me at both of those places. And then on LinkedIn, if you search Kevin Carter at EMQQ, you'll find me, and by all means, reach out and connect.
Excellent. Well, thanks so much for listening in, guys. And we have a lot more to talk about in part 2. We'll talk about the American election, what this means, and we'll go into some of the details of Alibaba, Tencent, Paytm, Mercado Libre, and so we'll talk about those things in the second episode. So if you guys are interested, stay tuned. All right. Thanks, guys.